Disposable income refers to the amount of money individuals or households have available to spend or save after accounting for taxes and mandatory deductions. It is calculated by subtracting these deductions from total income. Net current transfers, such as government benefits or remittances, can further influence disposable income. If these transfers are positive, they increase disposable income, while negative transfers reduce it. As a result, disposable income may be higher or lower than total income, depending on the nature and amount of these transfers. Disposable income can be examined through several variants, with national disposable income and private sector disposable income being two key measures. National disposable income represents the total income available to a country's residents for spending or saving after accounting for current transfers from abroad, such as foreign aid or remittances. This calculation starts with the nation's gross or net income and adjusts for these international transfers, reflecting the true resources available to the country. In contrast, private sector disposable income focuses specifically on the income available to households and businesses, excluding government transactions. Understanding these distinctions helps clarify how resources flow within an economy and the impact of external financial transfers. National disposable income is a key indicator of a country's economic well-being, and it is measured in two main ways: gross national disposable income, or GNDI, and net national disposable income, or NNDI. GNDI represents the total income available to a nation's residents for spending or saving, before accounting for depreciation. In contrast, NNDI subtracts depreciation, which reflects the loss in value of capital assets over time, providing a more accurate picture of the resources truly available for consumption and investment. Depreciation is important because it accounts for the wear and tear on machinery, buildings, and infrastructure, ensuring that income figures do not overstate the economy's capacity. These measures help policymakers and analysts assess the sustainability of economic growth and the real standard of living within a country. Disposable income aggregates in the private sector are essential indicators for understanding economic well-being. Private income refers to the total earnings from all sources, including wages, investments, and business profits, before any deductions. Personal income builds on this by including transfer payments such as pensions and social benefits, but excludes undistributed corporate profits. Personal disposable income is what remains after taxes have been deducted from personal income, representing the actual amount households can spend or save. These measures help economists assess household purchasing power and overall economic health, highlighting the flow of resources within the economy. Per capita income is defined as the average income earned per person in a specific area, typically calculated by dividing the total income of a region by its population. This metric is commonly used to gauge the standard of living and compare economic well-being across countries or regions. While per capita income provides a useful snapshot of average earnings, it has notable limitations. It does not account for income inequality, cost of living differences, or non-monetary aspects of welfare such as health and education. As a result, relying solely on per capita income can present an incomplete picture of true economic development and societal welfare. Gross domestic product, or GDP, can be measured in two ways: nominal GDP and real GDP. Nominal GDP calculates the value of all goods and services produced within a country at current market prices, without adjusting for changes in price levels. In contrast, real GDP uses constant prices from a base year, allowing for a more accurate comparison over time by removing the effects of inflation. This adjustment is made using price indices, which track changes in the overall price level. By focusing on real GDP, economists can better assess true economic growth, as it reflects changes in output rather than fluctuations in prices.